Hello. The purpose of this video is to walk through what a mortgage forbearance plan is, a few pros and cons of them. If you're somebody who has specific questions or wants specific information around a COVID mortgage forbearance plan, I've separated these into two videos. So there should be another video specifically addressing the COVID mortgage forbearance plans. This video is just to give some information more generally about what a forbearance is and how you can kind of decide if that might be a good fit for you. So a forbearance is just generally a temporary agreement that a borrower or a homeowner comes to with their lender that allows them to either suspend or pay less for a certain amount of time. Most commonly, it's a suspension of payments. Sometimes you will see forbearance plans where lenders will say, okay, we will only have you pay your interest for these months, or we will reduce the payment somehow to this amount of time. But most commonly, it's a suspension of payments. Basically, you're a borrower, something happens to you, and your bank tells you, okay, for these amount of months, you do not have to pay anything, we will forbear it. That's typically what you'll see with a mortgage forbearance plan. A forbearance does not change any terms of the original mortgage. So all it is think about it, just pressing kind of like a pause button on what you have to do. It doesn't change anything moving forward, and it doesn't change anything in the past. It's just kind of like a break in having to pay. I would say there are, four main pros of a forbearance plan. If you're somebody who has like a sudden financial hardship, it provides you temporary relief to just kind of gather your finances. And it allows you to recover from a temporary financial hardship. It allows you to prioritize, sudden financial expenses. So if you're someone who goes through some sort of medical injury that suddenly you have high medical bills for a short amount of time, or if you have to kind of divert expenses somewhere else, if you get a mortgage forbearance, you then can kind of shift money that you have coming in over to maybe more important expenses for those few amounts of times. It could be a low impact decision. And what I mean by that is, if you're someone who has a drop in your income or a spike in your expenses, but it's temporary, it's just kind of a low impact decision to take a break for a little bit, regroup, and then resume making your mortgage payments. There are some downsides to doing a forbearance, and they're not a perfect fit for everybody, right? Forbearances, I would say there's four main ones of these two. Forbearances do not solve long-term financial hardship. So if you lose your income or your income drops in a way where it is not set to recover, then a forbearance merely just puts it on hold, and then you kind of come back and you have to figure something out. And so if you're somebody who's undergone kind of a more serious and a more permanent financial hardship, a mortgage forbearance might not be a good decision for you. I would say sometimes forbearance plans provide homeowners a false sense of security. People feel relieved when they're told they don't have to pay. And I don't want people to fall into just feeling like everything's okay, because a forbearance plan really is just a pause. It doesn't solve the overall problem. Another downside of forbearance plans is sometimes the application process can be complicated and kind of unclear. You definitely want to make sure that you understand what your forbearance options are. You want to make sure you get a forbearance plan in writing so that there's no confusion about whether you have to pay or whether you don't have to pay. Kind of the last and main downside of a forbearance is sometimes forbearance plans can be unclear about what's expected from you at the end of your forbearance plan. And so I'm going to talk a little bit about that in a moment, but you really want to be able to decide, like, is a forbearance plan the right move for you, or do you need to look at some other sort of option? And so the way that you decide whether a forbearance plan is right for you, or the way I help my clients decide, is I walk them through kind of three questions. The first question is, have you had a sudden kind of drastic hardship that affects the household income? A sudden hardship would be, an injury you weren't expecting, or, maybe you have to cover medical expenses for somebody in your family, or you had a huge household repair issue hit that you weren't expecting. Forbearance plans are not usually for people who just kind of have a declining household income or a steady increase in expenses. If you have like a long-term financial problem, you'll want to look at something else. But if you have a sudden, drastic, unexpected financial hardship, that would be one prong of like a three-prong test. The second question you want to ask yourself is there a definitive end to the hardship? So if you suddenly have to pay $5,000 for a medical expense, but after you pay the $5,000, everything's over and everything just goes back to normal and there are no more expenses, that would be considered an end to the financial hardship. And then you'd want to ask yourself, is the household income going to recover back exactly to the way that it was before the financial hardship hit? So forbearance plans are really good for people who have something nuts happen to them quickly, unexpectedly, but once it's over, everything goes back to normal. Because you want to make sure that if you get on a forbearance plan, at the end of the forbearance plan, you have the requisite income to resume making those mortgage payments. So sudden drastic financial hardship, is there an end to that financial hardship, and will your income fully recover at the end of the period? If you feel like a forbearance is a good plan for you, then you want to talk to your bank about your forbearance options. Talking to the bank can be an interesting process. You want to make sure you get through to the loss mitigation department. That is the department that usually issues forbearance plans. But the number one thing to be aware of when you get a forbearance plan is you want to find out what is going to happen to you and what is going to be offered to you and what do you need to do at the end of the forbearance plan. So many forbearance plans run in a way where they temporarily pause the payments, and then at the end of the period of time that you both have agreed to, you just resume making your regular mortgage payments. So for example, the bank says, okay, you have a, for example, 3-month forbearance plan. At the end of the 3 months, you're just going to resume making your regular mortgage payments. That's the most standard forbearance plan that we see, and that's what I would label a good or a positive forbearance plan, because then you don't have a sudden lump sum due at the end. There is a different obligation and different kinds of forbearance plans where at the end of the period, you owe everything that you didn't pay. So there are some forbearance plans where they say, okay, you don't have to pay us for 3 months, but then at the end of the forbearance plan, you have to pay us the 3 months that you didn't pay. And so what's massively important is before you agree to a forbearance, before you start a forbearance, get in writing from your bank, number one, what the terms are, meaning how many months does it run for, and they should be able to put in writing for you what's going to happen to you at the end of your forbearance plan. You want to understand that, because if you're not going to be in a position where you have 3 months of payments due, it might be better to do something else or figure out how to continue to make your mortgage payments before you fall behind. I can't tell you how many homeowners go on a forbearance plan thinking they're on one where at the end they just resume making the payments, but then suddenly they get to the end and the bank wants the full amount. So you want to make sure that you understand what's going to happen to you at the end, and you want to get that in writing. The other third kind of forbearance plan we see is sometimes the banks will forbear principal payments for a certain amount of time, but they'll have you still send in your interest payments. And so you'll want to find out if you're making like a partial payment as part of your forbearance plan, again, what's going to happen at the end. Are they just going to have you resume, or are they going to have you pay everything that you missed? A common question I get is what happens to foreclosure activity during a forbearance plan? Please understand that, I'm a Washington state attorney, and so other states might do things differently. But if you are current on your mortgage and then you go on a forbearance plan, typically, this may not apply to your particular bank or particular investor, so make sure you get some specific information. But typically, a forbearance plan will not move your loan into default. It will not move foreclosure activity forward. It will show in the lender's system as literally a forbearance, which is just a pause. A lot of lenders will not agree to give forbearance plans if you're already defaulted on your mortgage. And so if you're already in default, lenders may not agree to put you on a forbearance plan, and you might have to look at some other sort of loss mitigation option. So the way a forbearance plan usually works is usually homeowners are current, and then they're proactive and they ask the bank for a forbearance plan. They get the forbearance plan, and that kind of pauses their foreclosure activity and does not default their loan because the bank agrees to give them this amount of time. If you're somebody who is already in default, meaning if you've missed some payments and your bank agrees to give you a forbearance plan, you need to be tracking your foreclosure activity to find out what the bank is doing. You really want to avoid what's called a dual tracking situation where the bank agrees to give you a forbearance but then continues with foreclosure activity. It's rare for a homeowner to be given an opportunity to do a forbearance if they're in default, but if that happens to you, if the lender gives you a forbearance and you know you've already defaulted, you need to be very careful to pay attention to your foreclosure activity, find out exactly what's going on, and get some help. Like I said, this is just general mortgage forbearance information. If you want information about a COVID forbearance plan, there's going to be a separate video kind of discussing those and what they're doing. So check out that video. At the end of a mortgage forbearance plan, if you are one of the people who did not understand that you would have to pay the full amount owed, and you get to the end of your forbearance plan and the full amount owed becomes due and you can't pay it, you likely need to apply for either a loan modification or a repayment plan at the end of it. And so if you got stuck on a forbearance plan, you didn't understand the terms, and you can't just resume making payments, you need to quickly figure out what your options are to do a loan modification or a repayment plan so that you don't let the loan spiral out of control, so you don't get farther behind. So, transitioning out of a forbearance plan is just as important as transitioning in, and make sure you have the resources available. You're talking to the bank, talking to an attorney to help you. Thanks.